Hi, this is Professor Marsh, and this is the wrap-up lecture for Chapter 9. We'll go through some of the topics in the chapter and then also the homework, and this makes up for the class that had to be canceled on Friday. So if you've got your books open, let's take a look at Chapter 9, and this is the chapter that's about responsibility accounting and decentralization. And if you'll remember, we had a couple of sections, section 9.1 and 9.2, that were basically business school type discussions, maybe principles of management topics about centralized and decentralized management and how to differentiate between the two, and where decisions got made. Did they get this? Were all the decisions made in one central location, or were some of the revenue and cost decisions pushed down to decentralized environments, as we saw in the example of some of those companies? And then when we got to the third section, we talked about responsibility centers, revenue centers, cost centers, profit centers, and investment centers, and how to differentiate between those various types of centers, and then also how to measure performance in those types of responsibility areas. And then in 9.4, we looked at the effects of various decisions on performance evaluation and responsibility centers, and we also looked at the issue of transfer pricing. And so that was the topic for most of the chapter, and that's pretty much what we went through. So let's go ahead and take a look at the homework for the chapter. In your book, you were assigned the exercise set A, problems 1, 3, 5, 6, and 7. And 5, 6, and 7 were basically the same problem at the same company, just coming at it at a little more depth each time we looked at it again. So the first exercise, exercise A1, so you can see there's nothing for the first two learning objectives. This starts with learning objective 9.3 regarding responsibility centers. And you've been hired by Hilton Hotels and Resorts. As part of your new role in the accounting department, you've been tasked to set up a responsibility accounting structure for the company. As your first task, your supervisor has asked you to give an example of a cost center, a profit center, and an investment center within the Hilton organization. Your supervisor is a little unsure of the difference between a profit center and an investment center and would like you to explain the difference. Well, this is, of course, very similar to the classroom situation where your professor is a little unsure of the difference, and so he's asking you to give him an example. So, example of a cost center, a profit center, and an investment center. Well, a cost center we can steal from our homework and from the discussion in the book, and say the maintenance department would be a cost center. Housekeeping would be another cost center. Profit center might be a restaurant or a coffee bar inside the hotel. And an investment center, that could be a new hotel location, maybe the Hampton Inn in Newberry, if it's owned by the corporation and not by a franchisee. So that's an example of all three of those. And then let's go on to problem 3, exercise A3, also from the third learning objective in the chapter. And this is from Bluff Run Golf Courses. We've got 3 courses that they operate, and you've got a classified statement of income for the 3 courses, the blue course, the black course, and the gold course. And so it shows revenue from various sources, and then there are some question marks. I guess the editors got tired or whatever, and they didn't fill this in, so there's a kind of a silly, simple math problem here to fill in the missing amounts. And so the blue course outings revenue is $11,000. That's the difference between the $62,500 greens fee revenue and the total revenue of $73,500. The black course wages were 56,300. That's the difference between the total expenses of 79,100 and the sum of the landscaping, repairs and maintenance, fuel, and utilities that are shown. So 79,100 minus 22,800 gives you 56,300, and that's your answer. And then the gold course operating income, that's just taking the total revenue and subtracting total expenses. So that's 70,800 minus 47,030, and that gives you a difference of 23,770. So that's your operating income, and that's your answer. Comment on the financial performance of each course. Well, the gold course is very efficient. It made $23,770 on greens fee revenue of only 42,800 and total revenue of only 70,800. So it's certainly the most efficient operator. The other courses less so. The outings revenue at the gold course is quite substantial, and so obviously it's they get a lot of group business. The black course doesn't seem to be. It's more popular perhaps for just playing the course and not so much for group business. And the blue course seems to have a relatively high amount of wages compared to its total revenue. So it does look like the maybe they're proportional between the gold course and the black course with respect to income, but it looks like that's kind of an outlier. And the way that you could analyze this is just to do a vertical analysis and let total revenue equal 100% and then categorize all the expenses as a percentage of those those total revenue. You'll see a lot of discrepancies in there. You'll see that the landscaping expenses are very high at the black course, even with its high amount of revenue, and the fuel costs and utilities costs are clearly not proportional to what you might think as the usage. So just not quite sure why that's going on. And then repairs and maintenance at the blue course are very high as well. So you can make a number of observations about that. There are big variations in those various categories, and it's probably worth asking the on-site managers why. And what limitation of analyzing this information is that you don't have a percentage associated with the expenses, and so it's you kind of have to ballpark it in your mind what the percentages might be. And if you did use Microsoft Excel or another spreadsheet application, you certainly would be well advised to calculate some percentages next to the various classified statements of income for them. Okay, that's question number 3. Now let's go on to Marley, not Bob Marley, but Marley's Manufacturing. And Marley's operates under a cost-based transfer structure. Assume you receive the majority of your raw materials from Department A, which sells to Department B. They have no outside sales. After calculating the operating income in dollars and operating income in percentage, analyze the following financial information to determine costs that may need further investigation. Hint, it may be helpful to perform a vertical analysis. Yes, it might, and certainly that would be something that you could do, and you could fill in the numbers and see what the operating income is in both dollars and percentage amounts, and that's it would certainly make sense to go up and calculate all of those expenses as a percentage of your overall total sales dollar too. So just to give you a some sort of apples to apples comparison. The vertical analysis, you're going to see that it's a very different situation for Department B versus Department A in terms of the allocation of corporate overhead and also the utility expenses are considerably higher too in proportion to sales. And so I guess maybe the Department B is more perhaps more intensive in terms of machinery and equipment and using utilities. So, but the striking thing, of course, is the costs that are allocated from corporate, and that is what drives Department B deeply negative. So the if you go and moving into exercise 6, as manager of the department in Marley's Manufacturing, based on the costs you identify in the previous exercise for further research, how does this impact the financial performance of your department? What are some questions you might want to ask or solutions you might propose to Marley's management? Well, maybe don't allocate those costs from the corporate overhead. That's not really fair in terms of the performance of Department B to have $15,000 in overhead dropped into their expenses, which takes them, from profitability to about a $4,000 loss. And, you might, in question 7, and your research of the market in previous exercises, you determine the market price is 15% below what you're being charged by Department of A of Marley's Manufacturing. How would you view this as a manager? Well, I'd much rather be charged the market price than a price that's artificially high. And so, that's really subsidizing Department A at the expense of Department B. And so maybe use a market price approach to the transfer price, which would then reduce the cost of goods sold to Department B by some $4,000, which would help bring them closer to profitability, and maybe look at some of the other alternatives for transfer pricing besides cost or even market price. You might have full cost, you might have a cost plus system, or perhaps a negotiated price, but certainly using just the cost of the Department A, you probably are going to wonder, what other results you would get if you used a different transfer pricing metric. So those are some of the considerations for that long three question problem, and I didn't assign number 8. So at this point, we're done with chapter 9. So we'll see you in chapter 10. Have a great day. Bye-bye.